And I'm excited about this because it's a sad reality that your life insurance as an entrepreneur, if you buy one of these permanent life insurance policies, may make more money on your policy than you ever will on it. And so there's a spectrum from oversold crap to billionaire grade tax shelter. And we're going to go through how you go from one end of the spectrum to the end of the spectrum.
Yeah.
So I know you love this topic, so I'm excited. You can't even help yourself.
I know. I'm interrupting you already.
So I think the first thing is that I wanted to call out is there's a conflict of interest problem, and there's commissions. Because why are there so many insurance agents, and why are they all looking for high-income entrepreneurs that we serve? Is because there's massive commissions. And so on average, if you buy a permanent life insurance policy, so think a whole life or an index universal life or a variable universal life, that the payout or the commission that the agent gets is going to be right around 100% plus or minus on average. It could span from like 40 or 25, 40% all the way up to 115%. But said another way, if you put $100,000 of premiums into your whole life policy in year one, your life insurance agent most likely made $75,000 to $100,000 of commission on that day alone when you sign and fund that policy.
Yeah, it's a lot. And of course, these are hidden commissions. So you don't get to see the commission. They don't share the commission generally. And when you have something that's hidden that pays someone a lot, it's an incentive to maybe recommend these things when they're not appropriate. Because life insurance is a tool. It's an important tool. It's a tool that needs to be used in every plan, whether it's when we did our buy-sell agreement, right? We funded that through term insurance with a period of time. We knew that at some point we wouldn't need the funding to buy each other out if that happened. And yet we see lots of business owners that don't have buy-sell agreements, or if they have one, they're not funded. And, term insurance is cheap. And then even permanent insurance has its place. But boy, this stuff gets oversold, and we see nightmares on the back end of when this is done wrong. And I have to say, in my experience, it's done wrong way more than it's done right.
Yep. And so we're going to put up a table here that shows the different policy types: term life, whole life, universal, variable, typical first-year commissions, renewal commissions, and really the conflict of interest risk. And the big thing for us here is we don't take commissions. We don't take referral fees. We don't take kickbacks. You need a fee-only fiduciary who's in your corner because as Charlie Munger always says, show me the incentive and I will show you the outcome. And, when someone has a hammer, everything starts looking like a nail.
Yep.
So let's jump into what these overfunded bank on yourself policies actually are and how they work and how they're sold. And then we could talk about a few different strategies that will build on top of this framework. So,
right. And by the way, bank on yourself is just one of the terms. Infinite banking, cash flow banking, the LEAP program. And one thing that entrepreneurs need to be aware of is these are marketing strategies. These are strategies to sell more life insurance to make more commissions. That's it. Under the covers, you have to look at how they actually work when they apply to you and how they can be implemented to your satisfaction, not to the agent's satisfaction. These have been going on for my whole career. For 30 years, I've seen these, and they have always a different marketing twist to try to sell these types of products. But that's what it is. It's a way to market and sell these products.
Yep. And I know, Jim, you were on a nice panel debating these policies on a separate podcast. So how about you tee up how you would describe or how these policies are sold. And then we can talk through some of the pros and cons, what's real, what's not real.
They're sold in a lot of different ways, but the big thing that the big selling point is that the tax benefit of life insurance. So life insurance, the money you put in is after tax. So you've paid your taxes and then you pay the premium, unlike an IRA where you'd get a deduction against your taxes. So it's after tax money that goes in. It grows tax deferred. And then on the back end, you can pull money out tax free if first you pull your basis out and then by taking loans against the policy. So that's the idea behind it. And it is a powerful idea and it can work in certain situations. The problem is the execution and the cost, because these are the most complicated and the most costly products that exist in financial services. In fact, a mutual friend of ours who's a life insurance expert and been doing it for as long as I've been doing what I've been doing, and he said anyone who says that they understand whole life insurance doesn't understand whole life insurance, because it's a black box. You can't see what's in there. You can't peel out the mortality costs, the admin fees. It's a black box. But what we do know is these policies are very expensive and they're very complicated, and they make a lot of money for agents and for insurance companies.
Yep. So I think the vision or what gets sold is, hey, put money in after tax. It's going to grow and compound tax free. And then whenever you need the money, you can just pull money out via a loan. But that loan and that interest is, they kind of say, going back to you. Now, in reality, there's a spread that the insurance company is making. So whenever they lend you money, you are paying interest back in, but there's a spread that they're going to make on it. And on top of that, the historical rate of return in this bucket is around 5.5% is kind of the typical crediting rate. And so you also need to see, like, how is this doing as an investment perspective or as an investment vehicle? Because we should, if this is a pure play investment, which is how it's framed up, the death benefit is sure nice to have, but this is really an investment vehicle. So therefore, let's go apples to apples comparison with other investments, whether it's real estate, crypto, stocks, bonds, private equity, venture capital, and let's compare on an after-tax basis. And then, of course, we need to factor in liquidity needs, etc. But I think at the end of the day, that's a big issue, is that you get locked in and the rate of returns are not very high, and you usually you're underwater for the first 3 to 7 years because those massive commissions are going out the door day one.
Yeah, that's very true. And I've even seen studies that show performance of things like whole life lower than that, 3 or 4% over time. Whatever it is, life insurance is a low return investment. You could say a low risk investment, but very expensive investment if you're looking at it as an investment perspective, that's one of the problems is I'm not sure I'd categorize it as an investment. It's a insurance policy. It has a death benefit. And if you use it for accentuating or diversifying your portfolio, you have to be very smart at how you do that. One thing about life insurance in general, and when we take it whole life, for example, because sometimes I've heard insurance agents say, well, term insurance, the death benefit never pays out, which is true. Very few term insurance policies pay out. Why? Because the insurance companies are good at underwriting them to know that you're probably going to die before the end of the term, so they don't have to pay you out. And then a lot of people might cancel their term policies when they don't think they need it anymore. On the other hand, whole life insurance, believe it or not, permanent life insurance, something like 80% of those, and there's a few different studies you can look up online, 80% of those never pay out because people cancel them before the death benefit. Why? They realize that maybe the structure wasn't done correctly. They overpaid. The money's not growing. They have friends that tell them that's not good for you. You need to get rid of it. For whatever reason, there's a myriad of reasons. When people say this is such a great thing for entrepreneurs, when you look statistically, a vast majority of entrepreneurs that buy life insurance, permanent life insurance, don't get all the benefits that they're promised at the beginning, whether it's because of their behavior, surrendering the policy, or because of the policy being designed poorly or putting too much in the policy. Because the other thing that I see is the entrepreneur will have, let's say, $20,000 a month of disposable income that they can invest. And the insurance agent says, oh, you should take 10 or 15,000 of that and put it into a permanent policy. So you also have to remember that this should come not as a huge part of your portfolio, as a smaller part of your portfolio. And the death benefit should be the number one and most important decision that you made. Because if you don't have enough death benefit to protect your family, that's the biggest concern when it comes to life insurance that I see.
Yeah. I mean, I think you buy term to get the death benefit. That's the cheapest way to get the death benefit. Align your term to when you're going to be financially free. Once you sell your business, have your liquidity event, you don't need the death benefit anymore. So you should cancel your term policy, right? It's an insurance policy, you know?
Although there are times when you want a death benefit to go all the way to the end, and that's where you can use things like second to die policies that reduce the mortality costs. That would be estate taxes happen at the second death, so that times that well, cuts down your costs. It could be a guaranteed universal life policy. Mm-hmm. Those now will guarantee to age 120 or even longer, so you get kind of just paying for the insurance piece and not worrying about the buildup of the money. If you need the death benefit at age 100, term isn't going to do it, right. But there's other ways to get it that much cheaper than the traditional, whether it's UL, VUL, whole life, or index UL policy that you're being sold to overfund it and to, create all these tax benefits.
And another problem too is, like you said, if you see an entrepreneur, one of the few cases where I do think these permanent policies make sense is an entrepreneur who wants to create that liquidity at death. And so generally it's going to be at a second to die policy. Usually you're going to always want that in an irrevocable life insurance trust because you don't want that in your taxable estate. Because that's another big problem is that even these people who are sold, maybe it's a $500,000 a year premium 7-pay policy, the death benefit's $25 million. Well, if my net worth was $20 million before that, if I actually do die, I now just created an estate tax problem.
Yep.
And that's in my taxable estate. So when I get the death benefit, I actually have to pay estate taxes on anything over $30 million.
If you're married, yeah.
If you're married, exactly. So that's another huge problem that they just kind of ignore. They try to, when it's convenient, say, oh, yeah, we get the death benefit. But it's like, well, you're also now creating an estate tax problem. So another situation where I do think putting a small part of your free cash flow into a permanent life insurance policy, whether it's whole life, IUL, or VUL, is when your balance sheet is so large that just the passive income that you literally just wake up and just the passive interest and income is going to always keep you in the highest tax bracket. Because I think then there's an argument to be made that this is a hedge against increases in tax rates. And so we're talking about how at the state level that's happening, but then at the federal level, it could happen too, right? Tax rates go up and down. So this could provide a tax hedge that, hey, I'm putting after-tax money in. And if I think tax rates could go up in the future, then it may make sense for me to have a hedge or another bucket, kind of like a Roth, that I can pull out tax-free. So
that's a good point.
That's another bucket where I think that for clients that are really above maybe $15, $20 million liquid, you tend to kind of be in the top tax bracket for the rest of your life just because things make money, that you're invested in. That's when, okay, hey, maybe it makes sense to carve a little sleeve out into these policies purely as a, yes, lower return, but tax bucket diversifier.
One thing that's interesting about permanent life insurance is when you're younger, the costs inside the policy are a lot lower, your mortality costs and everything else. So a lot of insurance agents are like, plow money in there when you're young. However, when you're young, you have the longest time horizon. So you can afford the most risk. And if you compare a permanent policy to stocks, real estate, private equity, the things that will give you much better returns and compound your money over time, you're better off investing in that when you're younger, not when you're older. So it's kind of interesting because, yeah, your mortality cost is lower, but that's the time when you should be investing your money in the high-risk assets like stocks, real estate, private equity, all those types of things, because you have so long and it's going to so dramatically outperform a permanent policy over 20, 30, 40 years. The amount that you'll have is so much different. And then you can manage the taxes. You can buy and hold. You can use low-cost index funds and things like that. So that's another problem is I see entrepreneurs sometimes, they're 30 years old and they're putting 80% of their disposable money into a permanent life insurance policy, and they're missing out on stocks, real estate, private equity, and all the things that are going to really grow their wealth from 30 to 60 or 30 to 50. And that's a problem that I see all the time.
Yep, you're spot on. All right, let's transition into premium finance.
Before we do,
yeah,
one more comment, and that is everything that we do in our practice is what I learned from a billionaire family in New York, and billionaires buy these types of policies too. One thing they never do is they never buy a policy without representation, with someone who knows the life insurance as well as the agent selling it, but doesn't get a commission, doesn't get a reward, doesn't benefit in any way whether they buy the policy or not. Every billionaire family has someone on their team who knows those policies when they shop for those policies to protect them and to negotiate down the commissions and also to structure those right and make sure that it's actually going to serve the entrepreneur more than serving the agent and the insurance company. So always have representation from someone who knows these products but doesn't benefit from you buying these products.
Good disclosure. Okay, let's talk about premium finance permanent policies. So we talked about permanent policies, whole life, IUL, VUL, which stands for index universal life and variable universal life. Now we're going to talk about premium financing, so ways you can borrow money to really overfund these policies. So this is just taking this strategy and adding on leverage, or debt, which always amplifies risks and return potentially.
Yep.
So we saw a lot of this in 2020 through 2022, because if you remember at that time, interest rates were at essentially 0% as we were coming out of COVID. And a lot of these policies are going to be based off of SOFR, which is a floating interest rate. And then it's going to be SOFR plus 2 to 3%. So you were paying maybe 3-4% interest. Now, if the market, and if most of these are in IULs, which are going to be tracked to the S&P 500, usually with a floor of 0 and a cap of 10. So over a long period of time, maybe you get 6% or 7%. So if you get 6% and you're paying 3% on the interest expense, because I'm borrowing money from the bank, then I'm arbitraging that 3%. So it really works out well. But when interest rates start going up, 23, 24, 25, and now we're around 2026, now it's 6 to 7, 8%, right, with the SOFR plus the plus a few points. That arbitrage has not only gone away, it's reversed, and now you're underwater. And some estimates suggest that up to 25% of all IUL annual premiums are financed. So that's a huge exposure, because right at this point in time, would you borrow from the bank and pay the bank back at 7%? if you can get, credited between 0 to 10%, right? You're gambling. And so what happens is when it goes wrong, you have to do a capital call. You need to put more money in. And so then I know we've seen entrepreneurs that have come to us with these plans, and every single one has been unwound because maybe it worked for a few years, but then the writing's on the wall when the interest rate environment changes. There's just not enough juice here, and they're just get frustrated. Capital call, putting more collateral up for the bank.
Yeah, and I've seen these when they can work. The problem is often the commissions are high. Often the structure of the policy is not done for the benefit of the entrepreneur, and they often don't understand the risk that you just talked about. Because when you're borrowing to invest, as you said, it accentuates both the risk and the return. And when you're doing something with a conservative policy like this, if your returns are below the interest that you're paying, you're upside down in the policy. So this also, because these premiums can be huge, the payouts can be huge. I remember I looked at one a couple of years ago, and I was able to figure out that the agent made $600,000 commission on that premium financing deal, and the client didn't really understand what they had. So be careful of all things, but especially premium financing, because the commissions are so big and the risk is bigger because of the lending, that if you don't understand these things, you could really get in something that causes a mess for you in the future.
Yep. And the whole story here is, hey, you put in $1 million a year, you borrow that $1 million, and you pay the bank 5%. We'll get 7% rate of return on average. So that's an average arbitrage of 2% per year. Keep doing that for 10, 15 years. And at a certain point, we've got enough money saved up in the vehicle that we'll actually take a loan out from the policy, go pay the bank off. And then now we have a loan, within the policy, we can stop paying in, and you got free insurance, right? Yeah. And you kind of arbitrage it. That's the story. That's the narrative. Like you said, there's massive commissions, but these blow up. And so Oklahoma State had they borrowed $16 million to premium finance policies on T. Boone Pickens and other famous alumni. This was back in 08, 09. They ended up paying $33 million total in borrowed premiums, and then the market collapsed coming in 08, 09. And there's rumors that they ended up, because they had to put up so much more collateral, that they lost across the board with all of these different donors $282 million from this. So this is where, right, it's like leverage. When things go wrong, they go wrong very quickly. So
what's interesting about it wasn't T. Boone Pickens that had that policy, right? A lot of times when I hear life insurance pitched as this grand idea, they talk about like all the rich people are using this magical thing. And of all the rich people I know, they generally don't use debt for life insurance. They'll use debt on multifamily real estate. They'll use debt on certain things. But generally, they only use debt in a situation where they feel that they understand the risk, they have enough collateral, they have enough safety, and they usually don't even do it on their primary residence. You can deduct that, but they usually don't have much debt. And that's how they survive all the hard times, is not having debt.
Yep. Yeah, it was Oklahoma State that was doing these policies on the alumni.
T. Boone said, I'll pee in a cup. You can take my blood. No problem.
Yep.
But I'm not giving you the money to fund the policy.
All right. Now we're going to talk through private placement life insurance, abbreviated PPLI. This is really the billionaire's tax wrapper. And PPLI is going to be fundamentally different because it's really not about the insurance. It's about the insurance wrapper. Because as we talked about in the very beginning, any of the assets and the growth in the insurance wrapper is tax-free. So what some billionaires do, or what private placement life insurance allows you to do, is put tax inefficient investments, think hedge funds, things private credit, these things that create a large tax liability every year. Well, you can put those in your own life insurance wrapper, which allows it to grow and compound tax-free. So it's just a way for us to really grow and compound our tax-free wealth. And instead of paying large upfront commissions, generally you're going to pay 1 to 2% of total fees. And then usually there's going to be some maybe 3 to 4% upfront premium fees. So a little bit more on an ongoing basis in terms of the fees, but you're not paying 50 to 100% of the upfront premiums and fees, which means that your cash surrender value and your account balance is a lot higher in those first several years versus an off-the-shelf product.
And this really came about because billionaires said, hey, we like that tax-free wrapper. We just don't like the insurance agent. Because what happens is no commissions. It's a fee product, so it's transparency. They know what they're paying. There's no surrender charges. I mean, you might wonder why if you buy a permanent policy, if you surrender it a year or two later, you don't get any money back. It's because they have to recoup the commissions they paid the agent. So there's no commissions. There's no surrender charges. It's a transparent fee. They know what they're paying, and they get the benefit, the tax benefit of the tax-free growth within the portfolio. They can't manage the money themselves, but most billionaires don't manage their own money. You have to have an investment manager of the portfolio. But like you said, things like venture capital, private equity, things that have a lot of negative tax impact, they can put it in that wrapper and avoid the taxes.
Yeah, and where we see a lot of this too is when you have that dynasty trust, you can put a PPLI policy that's going to be owned by the dynasty trust. So then when the matriarch or patriarch passes away, the death benefit is then paid out in cash in the dynasty trust. There's no estate taxes. And then you're also not creating an income tax bomb every year because all of the investments are accruing within that life insurance wrapper. And similar to the other policies, you can take a loan out using the life insurance as collateral. So
yeah, and since you went to the little more advanced, things like IDGIT's intentionally defective grantor trust, where you might have an estate plan where you've got money in this IDGIT. And the reason why it's called intentionally defective is because, as you know, the taxes are not paid at that level, which is a future generation. They actually filter back to the grantor, the mom or dad who created it, where they pay the taxes, which is good because you're taking money out of their estate. However, often the grantors get tired of paying the tax. They're like, we're paying the tax every year for this IDGIT, you idiot. And then what they do is they put that in a PPLI wrapper so that there are no income taxes that flow back to the grantor. So that can be a great solution for an advanced strategy like an IDGIT. I think that's what they say in Ireland. They call you IDGIT. IDGIT.
Oh, I love it. All right. Well, we're going to put up a chart here of the spectrum. So where do the policies fall? Different strategies, the overfunded whole life, the premium finance IUL, the private placement life insurance, and just some comparison metrics here. So when you as an entrepreneur, when your life insurance agent's making $100,000, plus commission on your policy, ask yourself, is this my retirement or your retirement that we're funding?